Hey guys, I hope everyone is doing fine. This is a short session on the recent collapse of a few banks, the Silicon Valley Bank, the Signature Bank of New York, and other banks, right? I just want to give you some insights into what happened and why the banks collapsed. I would also like to show you the relationship between the price and the interest rates in the market for a particular bond security. If you know bonds, the treasury bills, the mortgage-backed securities, these are fixed income instruments. They either pay you a variable interest rate or they pay you a fixed term interest rate. So let's say if there is a bond which is trading at a price of 1,000, I buy one bond, I pay the government $1,000. I take the bond, which pays me, let's say, 5% fixed interest rate. If the tenure of the bond is, let's say, 30 years, the government will or the bond will keep paying me every month the 5% on the investment, which is 5% of 1,050 bucks. I will be receiving every month until the maturity. And when the bond matures, I give or return the bond back to the government or the counterparty, and then I receive my original investment, right? So this is how the fixed income securities work. The fixed income securities are more safer in terms of the risk that you can take. They provide you uh, assured returns, assured interest rate returns, or assured variable interest rate returns, depending on the security and the term, the contract of the security and the maturity, right? So for a particular fixed income security, let's say if you buy the security or a T-bill, a treasury bill, or a mortgage-backed securities or a US government bond, right? It let's say if it pays you 5% per annum of interest, assume that the interest rates in the market are very low right now, which was during the COVID time where the interest was as good as zero. It was just kind of nil, which means if the interest rates in the market are low, which means that the inflation is very low, which means that you do not have enough opportunities to get returns outside the fixed income instruments, because these fixed income instruments like the treasury bills, the government securities, the mortgage-backed securities, they provide you assured return, which is a fixed percentage of return, and that is where then most of the investors go, right? So during the COVID time, it was the case, that was the scenario where we had very low interest rates because of the economy had almost collapsed because of COVID and other reasons. The interest rates in the market were very low, and all the investors demanded for fixed income securities which were paying 4 or 5 or 6% per annum of the interest, right? So in such scenarios, most of the investors go towards fixed income. The big portfolio managers and institutions invest in fixed income securities because they have assured return from the bond or the T-bill or mortgage-based securities, right? Now, because the demand is increasing, because the interest rates in the market are low and there is more demand for the bond or the fixed income security, the price of the bond goes up. And it happens vice versa in an environment where we are sitting right now, where the interest rates in the market are very high, where the inflation is very high, right? So you have other opportunities to make money, to get more interest compared to the fixed income securities, which pay you a minimal 4 or 5 or 3% of interest rate per annum, right? So in that case, the demand for the fixed income securities decreases. People and investors and institutions, they go back to the uh, other opportunistic investment classes to get more return. And that is where the demand of these fixed income securities in the higher interest rate environment is, it reduces, which is the reason the price of the bond or the fixed income securities falls during higher interest rate environments, right? Now, if you know the price of the bond or the fixed income security and the interest rates in the market work inversely, as I just explained. What happened during the 2020s, during the COVID time, during the pandemic time, when the economy in the US almost collapsed, the interest rates were almost zero. And the Fed started funding uh, everyone, started issuing checks to almost everyone, every other business, so that it wanted to keep the economy up and running. It didn't want to get into a scenario where we are almost into a recession in 2020. So during that time, whatever benefits these big banks, the Signature Valley, New York Bank or the Silicon Valley Bank, whatever benefits they got, whatever assistance they got from the Federal Reserve, they invested into the fixed income securities because they considered during this time of uncertainty where we didn't know what is going to happen, probably the fund managers of the banks might, or the CFOs or the chief financial officers of the SVB or the New York bank, they thought that they will get assured return in terms of uncertain economic environment. And that is where probably they went ahead and invested into the treasury bills, the government backed securities, the mortgage backed securities, and all the fixed income securities where they were getting the assured return every year, right? Quarterly or yearly, depending on the type of security. Now, there was another concern around these banks. They were also exposed to cryptocurrencies. They were exposed to uh, limited investors, like the Silicon Valley Bank was specifically funding the new technology startups or businesses. It didn't have a diversified portfolio of clients, right? So in terms of COVID, if you see when the demand dried up, when the economy started collapsing, the many people didn't want to take that risk. They didn't start up new businesses. They didn't go to the Signature Bank in the California to get funding, and the business started diminishing or decreasing for the Silicon Valley Bank. Uh, Now, at the time in point, as I mentioned, during the COVID time, during uncertainty period, most of the CFOs of these banks, which collapsed recently, they invested in the fixed income securities. And if you know, as I talked about the relationship between the interest rates in the market and the price of the bond, they purchased those fixed income securities from the government or the counterparties at a very high price, because during COVID, the interest rate was as low as zero. The price of the bonds or the fixed income securities were very high, which was expensive. So whatever, these banks invested billions of dollars into those fixed income securities. What will happen now is, as we progress, as Fed started funding every other business during COVID, it started reviving the economy. It started distributing checks to everyone in the United States, right? So that we get going during the previous government, as we know, that started inflation. So what is inflation? Is too much of money flowing in the market, too many people chasing too much of money in the market. That is what I would define as inflation. So when we had too much of spending from the people, they got the money from the Fed. When every other business got funding from the Fed or assistance from the Fed, or all the banks got all those checks, they invested. The banks started investing in the fixed income bonds or securities, which were very expensive during COVID. As we progress from 2020 to 2021, 22, and 23, Fed started seeing that whatever money it had distributed actually caused inflation in the US economy. And it always, one of the main functions of the central bank here in the Federal Reserve uh, is to maintain price stability, which means that they also want to keep inflation in control. And that's the reason since last 18 months, if you see, Fed started rapidly increasing the interest rates. Now, when the interest rates in the market increase, as I told you, the price of the fixed income securities and the interest rates were inverse. So when the interest rates started increasing in the market because Fed was increasing the interest rates, the price of the bonds that these banks were holding, they started decreasing, which means that the market value of these fixed income securities depreciated significantly. And these banks who were holding all these fixed income securities in their portfolio, they literally had hundreds or thousands of billions of losses on their balance sheet. And if that happened, most of the investors got disturbed. They probably went to the bank, started withdrawing funds. That forced the bank to sell more of these government securities at a lower price, which caused huge loss to these banks. And that's one of the reason the bank started collapsing. And to add to that, during COVID, since COVID until now, the banks had diminished businesses with their clients. They didn't have enough business or margin uh, to profit because of the uncertainty in the economy. And that's where, if the banks had purchased these fixed income securities or bonds or mortgage-backed securities, which were very expensive in 2020, and now if the value of those securities is significantly reduced by 50 or 60%, that is where all the balance sheet losses started reflecting, and investors got panicked and they started moving money out of these banks into the other banks, right, which are more safe, the bigger banks in the US. And that's the reason the banks like Signature Valley Bank or the Signature Bank of New York or Silicon Valley Bank, they started collapsing. But this is again to think about the different classes of investments that we can take and in which interest rate time frame where you should invest. So I think it also teaches us a lesson in what time frame you should invest into which asset classes, whether fixed income or equities, and again what should be the time frame for you to withdraw from there or to take your profits and go back and put your money to save to cash, right? Because if you see in 2020, starting 2022, the price of the bank was 162 bucks, and then it started collapsing. It is literally 0.01 now. It is on the verge of bankruptcy, probably. I'm not very sure what happened after that, but it is almost 0.01. So a bank which had its stock at 162 bucks in the starting of 2022, you can say in 18 months or 19 months that collapsed, and now the price of the bank is 0.01, which is a cent. I mean, it is unbelievable. It is like a spectacular failing of a bank I've ever seen. A few of the other banks like Washington Mutual in 2008, they had failed, but I cannot believe that it happened again, which it means that probably the decisions made by the chief financial officers of these banks were not correct. It also means probably that the economy is uncertain and we should be carefully investing. And whatever strategies you are taking for investment should be thoroughly reviewed before you start investing. So I hope you enjoyed this video. One of my friends had asked me to all these questions about why these banks collapse, and that's the reason I started making this video. So thank you and have a great day.